Let's get back to work. Live from New York City this morning. Good morning, good morning. Your equity market's slightly negative on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, economic data keeping Chair Powell on the sidelines. Goldman Sachs cutting recession chances to just 15%. And President Biden making his Labor Day pitch. We begin with the big issue. Goodbye August. Hello September.
We're heading into September.
A seasonally weak September.
There is a seasonal aspect to September.
The seasonal trends tend to be negative.
September's the worst month of the year.
The weakest month of the year.
We could see continued volatility.
We have the return of student loan payments.
That very important Fed meeting.
We're heading into September with very strong positive economic momentum.
We got a nice employment number.
Pretty good report.
You're seeing the kind of Goldilocks scenario that the Fed wants.
The Fed that is likely to press the pause button on the rate hiking cycle.
That's a pretty good backdrop for risk assets.
The economy in general is on decent footing.
We are on a wait and see.
More patience is warranted.
Kicking off the show with Citigroup's Stuart Kaiser, Jim Bianco of Bianco Research. Jim, great to catch up with you as well, Stuart. Jim, I want to start here on the Federal Reserve. Rate hikes on ice. Is that what they're going to say?
I think so. I think that they're going to probably pause at the September meeting because the market is giving you less than a 10% odds. But the question will become the November meeting because those are a lot closer to 50-50, and we'll have to see how the data plays out from there.
Stu, is that the Citi view as well?
Yeah, Jonathan, good morning. I think the base case is just that they'll pause in September, but they're going to want to keep November in play, just because they're going to want to respect the fact that they don't know how data is going to come in, and I think they want the market to just not price them as completely done with the cycle. So, yeah, pause in September and keep November kind of on the table just in case.
Bond market yields high this morning, 10-year up by 4 basis points, right now 422, 2-year up by a couple of basis points to about 489 or so. Jim, I'm struggling with the consensus view coming into September in this bond market at the moment. What is that consensus view now?
I think the consensus view is bullish. A lot of people are looking for a recession. They think that the inflation problem has been vanquished. They're looking at the data and they're seeing in the futures market a big short position, but that's probably a basis trade. And once you've taken that out and you look at positioning or you look at economist opinions, they're all kind of looking for rates to fall. And the contrarian play would be a further rate hike, or further rate rise, excuse me.
So sticky inflation, no cuts, stronger growth. Contributing to that, Jim, maybe this headline, just dropping across the Bloomberg. Excusing me for being distracted. Saudi to extend voluntary cuts of 1 million barrels a day until December, the end of December 2023. Looking at the oil market right now, 5-day rally coming into today. Crude with a pop, 89.64, just short of 90 here on Brent crude, up by 0.75%. Jim, a word on crude. Is that a reflection of a better demand backdrop, or is that just the supply story playing out?
Well, I think it's more of a demand story because you got to keep in mind since late June, crude oil prices are up more than 27% right now. Gasoline prices haven't caught up with it, and they probably will. When you see a big move like that, and yes, I know the Saudis have been voluntarily cutting. They've extended their cuts, but those have been in place for months. It's more consistent with a strong Atlanta Fed GDP and strong data and downgrading the probabilities of a recession because people are consuming energy because the economy is moving forward. I think that will continue to be the case. In other words, crude oil and gasoline prices might be a market-based measure of economic demand, and right now they're both very strong.
New highs for the year on crude right now, just short of 90. It's the South rally, Stuart Kaiser, hardly anybody's talking about. What do you make of it?
Look, I think our view here is essentially what Jim described, which is economic data continues to come in strong, and that's pushed cyclical assets, higher and also pushed yields higher. I think the big risk here, as we've talked about in the past, Jonathan, is that expectations have gotten a little bit more stretched, and the reaction function of equity markets to that data and actually to the rise in yields have become a little bit more troublesome. So, as a base case here, we're still relatively positive on the markets. Strong labor market, easing inflation, but there's definitely some fraying around the edges that I think you need to respect.
Well, Stuart, to build on that, this was a rally so far year to date that has been built on top of upside surprises, economic data coming in better than expectations. Can you make the same argument that we can build a rally on a series of downside surprises?
That would not be our view. Look, we believe equities are a nominal growth asset, and I think if you start to see disappointing economic data, you don't want to step in front of that. You want to let that weakness happen, and you want to buy at a lower level. So I think from my perspective, I agree with you. I think positive economic growth surprises what's driven the market higher this year, and that works in both directions. And if the nominal growth starts to weaken, I don't think that's something that you want to trade to the upside from an equity perspective.
Here's another headline, 2 in the last couple of minutes. If you are just tuning in, let's get up to speed together on the commodity market at the moment. The first headline from the Saudis to extend voluntary cuts of 1 million barrels a day until the end of December 2023. The second headline, this one from Russia to expend a 300,000 barrel a day oil export cuts through December. They're trying to support the crude market. Jim, I'm going to throw in iron ore as well. So crude at new highs for the year. Iron ore at highs we haven't seen since maybe April. This all happening with a slowdown developing in China. Jim, what's the signal you take from that?
Look, I think when you look at the broad commodity markets as they move higher, especially in the industrial metals where iron ore is and in energy, the takeaway is that the economic strength or the nominal growth in the economy globally is stronger than people think. Yes, China is slowing down, but it seems like the rest of the world, even though we keep talking about recession and slowdown, seems to be compensating for that, and that's why you're seeing higher commodity prices. And if we are seeing higher commodity prices, eventually that should translate into higher yields. Again, as we talked about earlier, at the same time when everybody's positioning themselves for a fall in interest rates.
Well, right now it's fueling higher crude prices through 90 on Brent. Brent crude at $90 a barrel, up by more than 1% on a session. WTI crude just short of 87 here at 86.99. Turns through 87 briefly, up by 1.8%. Jim, let's stay on top of this oil story. Have we seen enough from China? Enough from China, from your perspective, to suggest they can put a floor under this growth risk now?
Not yet. I think that the Chinese have really got problems with their property market, and they've got other issues they have to deal with before we start to say that there's a floor there. Now, maybe it's priced in their financial markets might bottom, but their economy won't. And let's keep in mind what extraordinarily is happening there. They reopened after zero COVID in January, and yet it might wind up being that this year is the same growth or worse than the year that they were welding people into their houses last year, which is an incredible statement to say on its own. And it underlies the big problems that the Chinese economy has, which is why I don't think I've seen enough to say that they've got a handle on it. And it isn't just that they need a couple of more basis points cut from the central bank in order to spur growth. It's much more structural than that.
Stuart, how does what happens in China shape your view of what happens here?
Look, it definitely matters. I think the narrative around China and the impact on U.S. equities has shifted over the last month. Initially it was China's exporting deflation, and that's going to be positive. It's going to help the Fed. I think that discussion has frankly shifted to something that's more about a negative growth impulse and potential event risk coming out of China. So I think it does create a headwind from a growth perspective. Obviously also impacts European equities, particularly German exporters and luxury good manufacturers. So there's definitely an impact, and I think the narrative around it has shifted much more negative over the course of the last month or so.
It's certainly amazing to see growth in China disappoint, coming much, much lower than expected in 2023 relative to expectations of 9 months or so ago at the start of this year. And see crude back with a 90 handle on Brent. That's the latest for you this morning. 2 headlines, one from Saudi, one from Russia. Saudi Arabia to extend voluntary cuts of 1 million barrels a day until the end of December 2023. Throw in Russia to extend 300 barrels a day oil export cuts through December. And you've got the recipe for a higher oil price right here, through 90 for the first time since November. That is a new high for 2023. Crude right now, Brent up by 1.3%. WTI up by 1.9%. To Jim Bianco's point on the bond market, fueling maybe some upside in yields here. Treasuries down, yields up by 5 basis points on a 10-year 4.22. Levels we've seen through much of this morning, up by 2 basis points on a 2-year, up to about 4.90 on a 2-year yield right now. Jim and Stuart are going to be sticking with us. Let's get you some movers elsewhere, with equity futures still just about negative by 0.1%. Here's Simone Foxman.
Yeah, John, equity futures may be looking negative, but Airbnb shares are rallying after it was announced that it would be included in the S&P 500 index as of September 18th, that along with Blackstone. And this really highlights the importance of passive index funds, because as we speak, the local law 18 in New York City is going into effect, and that severely limits the company's operations. But we see shares still up over 6% in the pre-market. Also watching shares of Nikola, there were local news reports of a semi-truck fire at Arizona lithium facility in Tempe last night. There were no injuries reported, but there have been a lot of concerns about the possibility that there are battery problems that cause fires in Nikola's electric trucks. We're also closely watching Warner Brothers Discovery. We're not seeing a big movement at the moment right now, but we're the company guiding lower adjusted EBITDA for the full year, after a $300 to $500 million hit from the impact of these strikes. That despite the fact that Barbie has become the best grossing movie worldwide this year, John.
More from Simone around the opening bell. That opening bell about 20 minutes away. The latest in the oil market, 6-day rally on Brent crude, up another 1% today, briefly through 90, just about there right now. $90 a barrel for the first time since November, as the Saudis and the Russians keep pulling back. Coming up, President Biden making his Labor Day pitch.
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union.
Latest from Anne-Marie up next.
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union. I'm proud to be the most pro-union president, according to the experts about in American history. And by the way, I make no bones about that.
The president attempted to shore up ties with labor unions in Pennsylvania, downplaying the threat of a potential auto strike, telling reporters, quote, "I don't think it's going to happen." The contentious negotiations leaving an opening for Republican frontrunner Donald Trump.
What's happening to our auto workers is an absolute disgrace and an outrage beyond belief. Both the UAW bosses and the big three auto executives should be screaming at the top of their lungs. They should be ashamed of themselves, demanding that Joe Biden cancel his brutal electric vehicle mandate before it destroys the entire U.S. auto sector. To every auto worker, I stand in total solidarity with you in your fight against Joe Biden's job-killing Green New Deal insanity.
Donald Trump on the offensive as voters overwhelmingly think President Biden is too old to run for re-election, and giving him low marks for his handling of the economy, according to a new Wall Street Journal poll out in the last couple of days. Bloomberg's AMH joins us from Washington, D.C. Anne-Marie, who's going to win that battle for those unions?
Well, for the UAW, Jonathan, at the moment, it's still up for grabs in the sense that they have not come out and endorsed anyone. And they've said that people in Washington need to take note about what is going on. If they want our endorsement, they need to be there for us. So that is something you see the former president, Donald Trump, try to tap into. He was out with a Truth Social post yesterday about this, saying there's an EV glut and UAW should not be backing the Biden administration. We should note the UAW did back Biden in the last round. They likely will lean towards the Democrats, but they're probably just using this endorsement as leverage at the moment, the same way they're using a strike as leverage at the moment, as they are up against the three big auto companies. And Jonathan, that contract expires September 14th. And when you heard from President Biden yesterday, is that when he said he didn't think there would be a strike, Sean Fain, the UAW president, came out and said he must have more information than we do.
AMH, the president says he's the most pro-union president ever in the history of the United States. I have no idea what that means. Isn't this the most easy time to be the most pro-union president of the United States, given where union membership is relative to where it was decades ago?
That is true. Relative to decades ago, if you look at the 1970s, an organization like UAW had more than 1 million workers. Right now, it's a few 100,000. But at the same time, the president does want to make sure that he is talking about labor unions. He talks about the fact that he's a son of Scranton. This is where he was talking on Labor Day in Pennsylvania. This is something he wants to lead into. His biggest issue, though, Jonathan, is one of the biggest gripes the UAW has is with the electric vehicles. When you see this administration come out and talk about loans or subsidies or grants for companies to build battery plants, the UAW, they do not have kind words for this administration.
His biggest issue this morning is in the oil market. Anne-Marie, let's go there. Two headlines in the last 10 minutes or so. One from Saudi Arabia, one from Russia. The message pretty clear. We're not going to stop pulling back anytime soon. How do you think this White House responds to that?
Well, Jonathan, this kind of goes to their industrial policy of wanting to electrify the grid. They wouldn't have to worry as much about what Saudi Arabia was doing. What we're seeing from the Saudis is that it's prolonged this cut. We didn't think it was going to be this long, and that's why you see Brent prices spiking above $90 a barrel. The administration was already concerned with gasoline prices. They're nowhere near they were last summer when they hit above $5 a gallon, but they are trending towards $4 a gallon. That will be very difficult for this administration that is still dealing with inflation. Yes, the rate of inflation is slowing, but they're still dealing with inflation. This continues to show up in polls, and it's why the Americans give the Biden administration poor marks on the economy.
$90 Brent right now on the screen at 1.5%. AMH, thank you. Anne-Marie with the latest down in Washington, D.C. Some final thoughts from Stuart Kaiser, Jim Pianco. Jim, let's pick up on that crude story. Crude right now at 1.5%. September 20th, the Federal Reserve. We can work backwards. September 13th is CPI. Jim, some upside risk to the inflation story into year-end from your perspective?
Yeah, I think on two levels. On first level is that September of last year was a small number. It was 0.2. We're looking for somewhere between 0.6 and 0.8 for this month. In other words, a base effect that could push year-over-year inflation up to 3.7 or 3.8. And if you extend that through the rest of the year, it really does look like year-over-year inflation bottomed at 3% in June, and it's going to probably start drifting towards 4%. Now, that's not catastrophic, but it's certainly not the type of number that's going to get the Fed to be talking about 4 rate cuts next year if we end the year at 4% inflation.
Stuart, how would you expect equities to trade around that kind of story? If Jim's right, what kind of price action would you be looking for?
Yeah, I mean, our view is pretty similar, is that you probably saw the two weakest prints you're going to see this year over the summer, and, potentially, A, some upside risk, and B, you're probably just also going to tick higher relative to those very low numbers. My view here is as long as inflation volatility remains relatively well contained and you're kind of in a slowly easing or grinding lower type inflation environment, equities should be okay. If you saw something like 0.6, 0.8 and inflation actually hooked higher, obviously the market would have to price that risk a little bit. But big picture, inflation volatility's come down. The rate of inflation has sort of stabilized a bit. And I think, what equity markets want is clarity and certainty. So if you have sort of stable inflation, stable jobs, I think equity markets can handle that pretty well.
Stuart, over the weekend I was reading through it. You gave a base case, a tactical view and a contingency plan. Stuart, can you go through that for us now?
Yeah, sure. Our base case, as I mentioned, is, job market remains pretty solid. Inflation is easing, but a little bit sticky. And I think, that allows equity markets to work, probably with, not the type of velocity we saw earlier this year. Tactically, we do like hedging markets. There is the chance here that inflation does tick higher. You're running to the show, mentioned seasonality a few times. So that's obviously a risk in the background. China, higher rates. Market technicals, options flows. There's a lot of tactical reasons, I think, to be a little bit careful, and we do like hedging through till the end of the quarter. The contingency, though, I think is the key thing here. It's what could really disrupt this rally. And we've put 3 things out there, but number 1 on that list is U.S. labor markets. And I do think if you see U.S. labor markets continue to start to weaken, meaningfully, then you are going to see equity markets trade lower. Our view is you don't want to step in front of that. You don't want to buy the first sign of weakness. You kind of want to let that weakness play out. So the contingency for the markets here is the strength we saw in the labor market on Friday, doesn't get repeated. Labor market and services sector comes under pressure, and I think that's your bigger downside risk. Hedging-wise, we would focus on U.S. retailers as a way to play that story.
In other words, Stuart, bad news is just bad news.
Always. They wouldn't call it bad otherwise, right? They would call it good if it was good.
Jim, you on the same page?
Yeah, I am. I think that definitely on the page that, bad news might wind up becoming bad news as we move forward from here. But I think that when you look at the labor market, I want to go back to what you and Anne-Marie were talking about. The labor situation, especially among unions, which is only 6% of the labor force, is getting to be very substantial. I think one of the things the UAW is looking at is a 32-hour work week, a 4-day work week. They want to go hybrid like everybody else does. And these are intractable problems. So the labor market could give us quite a bit of volatility as we move forward, unless there is some kind of a deal. And then you've got potentially a transit worker strike in New York City coming right after that for the same reasons.
Sign me up, Jim, not for the strike, but for the 32-hour work week. Now, Jim, you mentioned the union membership and how low it is, particularly relative to where it was several decades ago. You can make the argument that maybe these negotiations are meaningless for the overall labour market. Do you think there's a signal effect here, though, Jim, that we all see those headlines, we get to year end and we say, you know what, I'll have some of that as well?
Oh, yeah, I think it all started with the UPS workers getting $170,000 a year to deliver packages, that is reverberating through not only the West Coast port, but, the UAW and the transit workers and everybody else is saying, I want to get some. And yeah, you're right. 94% of the workforce is not unionized, but that 6% is. If they walk out on strike, like the Hollywood writers' strike, another one, it can be very disruptive for the economy as we go forward.
I'll form a union for the three of us, guys. 32-hour work weeks coming up. Jim Bianco, Stuart Kaiser, to the both of you. Thank you, guys. Going into the opening bell about 7-8 minutes away. Equity futures here on the S&P 500, slightly negative through most of this morning. On the S&P at the moment, we're down by 0.15%. This big move in the commodity market over the last couple of weeks. This is day 6. A 6th day of gains for Brent crude, through 90 for the first time since November. So we have a new high for 2023, $90 and about 60 cents, up by 1.8% off the back of these headlines that Russia, Saudi Arabia are going to keep on pulling back. Just keep on pulling back. The latest headlines from Saudi to extend the voluntary cut of 1 million barrels a day until the end of December 2023. And right at the same time, Russia to expend the 300,000 barrel a day oil export cuts through the end of the year as well. Crude up this morning by 1.76%. Coming up in the morning calls and later, Goldman Sachs growing more confident about a soft landing in the US. We'll have that conversation with PIMCO's Tiffany Wilding. This is where we've been all morning in equities, just a little bit softer on the S&P, down by about 0.1%. That's the price action. Let's get used to morning calls. First up, RBC upgrading American Express to outperform, pointing to manageable credit trends and the company's double-digit revenue growth outlook. The stock is up by 1%. BNP downgrading General Mills to neutral, expecting cautious consumers to spend less on premium pet foods. That stock is down by 0.8%. And finally, Bernstein upgrading Lowe's to outperform, seeing a favourable setup with multiple catalysts on the horizon. That stock is up by 0.6%. Coming up on this programme, we speak to PIMCO's Tiffany Wilding on what she calls a Goldilocks jobs report. That conversation up next, your opening bell, just around the corner. 25 seconds away from the opening bell, coming off the back of the best week of gains on the S&P 500 since the middle of June. Futures right now negative by 0.1%. On the Nasdaq, down about 0.2%, with Fed rate hikes seemingly on ice. More data still to come before we get to the 20th. The 13th is your next CPI report. There's your opening bell. Switch to the board and get to the bond market. Yields look like this in the Treasury market right now. Yields higher by 4 basis points, $4.22 stronger. The euro down to 107.45. We're negative by 0.5%. The lowest, the weakest euro, going back to about June. The rally in the commodity market getting everybody's attention. It is day 6 for Brent crude. It is day 8 for WTI. Brent crude is up by a couple of percentage points and through 90 for the first time going back to November. For WTI, longest winning streak going back to the start of this year. WTI crude, $87 and about 20 cents. We're high here by 2%. That's the cross-asset price action at the moment. We need to look at one thing, ARM, one of the most anticipated stock listings of the year so far, downsizing its IPO and now planning to raise as much as $4.87 billion in what would still be the biggest IPO of 2023. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. According to the Form F1, ARM will offer $95.5 million shares, 955.5 million shares in the form of American Depository Receipts, or ADRs, priced currently in a range of $47 to $51 each. As you said, that would see them raise $4.87 billion. Even at the bottom end of that range, if they price at $47 a share, it would still make this the biggest IPO globally of the year, surpassing Johnson & Johnson's consumer health spin-off of Kenvue. You'll remember that came in raising $4.37 billion. A lot of interest here, partly because we see it as a kind of starting gun for the IPO window for technology companies. There are a number waiting in the wings, as you know. Previously, we believed that ARM wanted to raise between $8 and $10 billion at a much higher valuation, say $60 to $70 billion. But what happened or transpired was SoftBank acquired the 25% stake of ARM that the Vision Fund held. And we know that all told, after the transaction, SoftBank will still control 90% of the shares, which is an interesting dynamic given the kind of big name cornerstone or anchor investors that are on this deal, which include Apple, Nvidia, AMD, Alphabet, Intel, among others that Bloomberg's reported, but certainly one that we're watching very closely.
Ed, let's make it really simple. So they're going to raise potentially half of what they hoped to raise only a few weeks ago. In terms of the valuation, it might be in the 50s. They were hoping it would be closer to 70, at least in the 60s. Ed, is that a SoftBank problem or a broader market story?
I think a mechanical problem. You know, it's by virtue of the transaction that SoftBank's done. I think, like, even based on the math that Bloomberg's done, at the top end of the range, $51 a share, it will have a valuation of $54.5 billion. You know, part of the psychology of this whole IPO situation and ARM going first is a lot of names that are waiting in the wings, want to see how it's going. But ARM, like everyone else, and SoftBank, by virtue of holding 90% of the company, wants to leave a little room for upside. That's what I keep hearing from bankers and sources that I speak to in the tech industry. And remember, ARM aside, a lot of these companies went through painful down rounds over the last 18 months, but with the longer-term goal of going public and having some potential upside out of that being the motivating factor.
Just set the bar a little bit lower. And thanks for the update.
Exactly,
Thank you, buddy. 3 minutes into the session right now, negative 0.1% on the S&P, pulling back just a touch on the Nasdaq by 0.4. Let's stick with the tech sector. Barclays upgrading Oracle to overweight with a street high price target. The analyst writing this: we see a multi-year opportunity for solid growth at high margins, partly fueled by emerging AI workloads, which will be the key to the overall story. Isabel Lee has more. Hey, Isabel.
Hey, John, and that price target is now one of the highest in the street, from 150 to 150 from 124. And 150 is a 24% increase from Friday's close. Barclays sees scope for strong growth at high margins, and that's supported by Oracle's software as a service and its cloud infrastructure, both of which it said can outweigh lower growth parts of the business. And just last week, UBS also upgraded Oracle to 140. UBS is also citing the cloud infrastructure as well as the GPU capacity of Oracle. AI really seems to be the theme of the year, John. And recall in March, NVIDIA extended its collaboration with Oracle, also in relation with its cloud infrastructure. And as UBS said, the AI story still has a lot of room to play out. Oracle is now up some 50% year to date, John.
And up about 0.4% this morning. Isabel, thanks for the update. Thank you. Want to turn to some new names potentially on the S&P 500. Both Blackstone and Airbnb will join the index prior to the opening bell on September 18th, replacing Lincoln National and Newell Brands. Simone Foxman on top of that one. Hey, Simone.
Yeah, this is a long time coming for both of these names, which have multiple share classes. And that was something that wasn't able to be allowed. You couldn't be in the S&P 500 index if you had multiple share classes until the S&P Dow Jones repealed this rule back in April. So just to recap, to qualify, you have to be a highly liquid U.S. firm. You have to have a market cap of at least $14.5 billion. And you have to meet certain metrics of profitability, liquidity, and share float standards. Now, Blackstone will become the first alternative asset manager to ever be included in the S&P 500 index. This despite the fact that it went public back in 2007. But after they dropped the rule, both Airbnb and Blackstone seen as benefiting here. And of course, this despite some unfavorable rules that come into effect for Airbnb today. We can see the impact on the shares, rallying 3%, over 3% for Blackstone, over 7% for Airbnb. John.
Simone, thank you. 5 or 6 minutes into the session, your update right now, negative 0.2% on the S&P. No drama there. On the Nasdaq, down by 0.4. Now, I'm not sure what would make you more miserable, being a Manchester United fan over the weekend or holding the stock this morning. I'm looking at my floor manager right now, who is a Manchester United fan. Stick with me. The stock is down by about 11.4%, 5 minutes into the session, as Man United may be taken off the market after the Daily Mail reported that the Glazer family isn't getting offers matching their asking price, writing, quote, "The Glazers are thick-skinned and won't be influenced by any negative fan reactions." Katie has more. Hey, Katie.
Hey, John. Yeah, you take a look at shares this morning, currently off by 11.5% after the report in the Daily Mail over the weekend. According to sources, the Glazer family, that thick-skinned family, they originally hoped to attract multiple serious bidders here, but only ended up with two. We're talking about Sheikh Jassim of Qatar and Jim Ratcliffe. Now, the Glazer family reportedly taking the team off the market. They're going to try again in 2025 when hopefully improved conditions will attract more bidders. And the Glazer family is looking to sell the team for between 7 to 10 billion euros at that time. Again, according to Daily Mail sources, as of Friday's close, you look at the market, Manchester United valued at $3.9 billion or about 3.6 billion euro. Now, it's worth noting here that when contacted by Bloomberg, a team spokesperson declined to comment on, quote, rumors and speculation. But even still, you can see the drama playing out in the stock market. Shares now off by 11.7%. If that holds, John, it'll be the worst day since February.
Did they comment on the Arsenal game? Kelly, that's what we all want to know.
I barely know what we're talking about here, John, but I'm not sure.
We appreciate your honesty. Katie, thank you. On top of the stock, more than the game over the weekend. Would you like to talk about? No, don't want to talk about the Arsenal. No? OK. Goldman Sachs cutting its US recession odds down to 15% from 20%, writing this. Real disposable income looks set to reaccelerate next year on the back of continued solid job growth and rising real wages. We still strongly disagree with the notion that the long and variable lags of monetary policy will push this economy towards recession. PIMCO's Tiffany Wilding offering her own assessment after Friday's payrolls data, writing the following. This was a Goldilocks report for the Fed. Labour markets are cooling but not falling off a cliff, and the slowing is likely to continue as the economy faces various headwinds in the second half of 2023. I'm pleased to say that PIMCO's Tiffany Wilding joins us now for more. Tiffany, let's start there. The kind of slowing that you're expecting into year end for some really phenomenal numbers we're seeing in the third quarter.
Yeah, well, certainly consumption has been the standout this year. The consumer has been very strong, and that's pretty aberrant from historical hiking cycles. You do tend to see more moderation in consumption as labor markets slow. We're just really not seeing that. Consumption in the third quarter looks like it's running above 2.5. Obviously, GDP tracking reports also look like they're closer to 3. So this is an economy that just doesn't seem to want to quit. Now, nevertheless, though, we are seeing indicators, higher frequency indicators that would suggest that things are slowing. So we have student loan repayments that are starting. Treasury daily data suggests that people are actually prepaying that. And at the same time, they're spending less. So high frequency data from credit cards suggests that we are seeing consumers that are starting to pull back. Add to that, that you have seen much less credit creation overall for the economy this year, and that is a recipe for slowing. Now whether it actually pulls us into a recession or not, I think that's more of a question mark here, just because of the ongoing resilience in the U.S. economy.
Well, do you see us on a path towards returning inflation to 2%? Are you confident we're on that path, Tiffany?
Yeah, well, we're certainly going to get some good news on the inflation front in the back half of this year. But really, that good news is centered around some of the pandemic-related effects just fading. Of course, things in China have been much weaker than expected. They are, as a result, exporting some disinflation. That's going to help U.S. retail goods prices going into the holiday season, which many consumers will be happy about. But nevertheless, other measures of inflation, wages, for example, in the United States, they still look sticky. This super core measure that the Fed loves, services ex shelter within the PCE inflation measure, also still looks relatively elevated. So one of the things that we've been noting, and this is consistent with the Fed's forecast, is that you do need to see some labor market cooling in order to get that down. And I think it's a question on whether we'll see some labor market cooling just because the economy's been so strong.
That's the labor market, throw in housing as well. Tiffany, we could look at commodities too. Can I just get a comment, Tiffany, potentially from you on whether this commodity market move complicates the Fed's effort with Brent, WTI back in and around $90 a barrel?
Yeah, well, certainly, headline inflation matters. It matters for how consumers think about future inflation and inflation expectations. But on the other side of that, it also matters because higher gas prices will affect consumers' ability to spend on other discretionary items. So it's a little bit of a mixed bag in terms of how it affects the economy. We still, in terms of the underlying inflationary pressures, we like to look at core inflation. And again, that's going to look a lot better in the second half of this year, with some risk, though, that maybe it re-accelerates if the economy doesn't cool.
So, Tiffany, when we get forecasts next up from the Federal Reserve, how do you think they'll compare to the last set of forecasts we got earlier this summer?
Yeah, so they're going to be a bit of a mixed bag in terms of their implications for the rate path. So we do think Federal Reserve officials will have to revise down their core PCE inflation forecast, at least for the end of this year. But at the same time, they're probably going to be revising up their growth forecasts. And there's been some good news on the labor market front. They could have to revise down their unemployment rate forecast. So all of that, sort of suggests, maybe they keep that rate hike in the back half of this year. Maybe they don't. But this is coming up in September. We would also argue there's a lot more data between now and the end of this year for them to think about. And I guess overall, just looking out to 2024, if the economy is not cooling, if we are still running at above trend growth, if the labor market, the unemployment rate is still at these levels, kind of 3.5 to 3.8, it's possible the Fed might even have to do more. So I think that's something that that we're grappling with, not our base case certainly, but
sure.
Something that's the risk that's out there.
Well, let's take it one step further. Let's play what if for 2024. Tiffany, are you still of the opinion that, let's say inflation is 2 point something, that they won't be willing to do anything about it? They won't be willing to crush the economy or the labour market. They'll just tolerate 2 point something.
Yeah, certainly. I mean, I think if it's a two handle, that's probably good for the Fed. But I do think there's questions around if the labor market remains this tight. It could stay around 3, which is a little bit more cuspy. Yeah, but overall, I mean, I think there is a question around if you get it down to 2.5, let's say, and you continue to forecast it moving lower over the next few years, then maybe that is all you need to do. And that would be very similar to what the Fed did in the 90s with their opportunistic disinflationary strategy. And I would say if you look at economic performance in the 90s, it was pretty good. And overall, 2 is really not, it's not a magic number, if you will. I mean, it's, 2% inflation, that there's not a lot of cost benefit analysis around 2 versus 3 versus, price stability in terms of their target. Nevertheless, though, as Chair Powell said, they're probably not going to change their inflation target, but they could alter their strategy within that target, to let it go a little bit above for a period of time.
Tiffany, thanks for the update. As always, one of the best. Tiffany Wilding there at a PIMCO on the look ahead for 2023 and 2024 as well. This just in from Anne-Marie. AMH wants you all to know that Man U goal was offside over the weekend, for whatever that's worth. 14 minutes into the session, your equity market slightly negative on the S&P. Coming up, China's big breakthrough.
China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry. So the second prong of the strategy, holding China back, has taken on more prominence in recent years.
AMH and Ed Ludlow, your team coverage up next.
China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry. And that's why the US, Japan, and the Netherlands in particular have tightened up their export controls on chip-making tools, which now can no longer be transferred to China to help China produce cutting-edge chips. And so this second prong of the strategy, holding China back, has taken on more prominence in recent years.
Chris Miller there of Tufts University weighing in on China's chip race as the US-China tech war heats up. A major breakthrough in the last week, a teardown of Huawei's newest smartphone, revealing an advanced 7-nanometer processor. A sign Beijing is making progress in a nationwide push to circumvent US sanctions. Your team coverage starts right now with Bloomberg's Anne-Marie and Ed Ludlow. Ed, just how big of a breakthrough was this for China?
Well, in layman's terms, this is the best ever made in China chip. That's the easiest way to understand it. 7 nanometer nodes are, for China, where they're at in chip manufacturing. You'll remember on the show a week ago, Jonathan, there were local media reports and speculation that the processor in the Mate 60 Pro might be 5 nanometer. And that was very surprising because broadly the industry does not think China has got to that stage. What the teardown that you're looking at right now, and actually any second you will see the processor known as the Kirin 9000S processor confirms, is that it is 7 nanometer. That is 2 generations removed from the cutting edge, which is 3 nanometer. But what's so important is that semiconductor manufacturing international, and you're looking at the Kirin right now, that is the processor. But what is so important about Semiconductor Manufacturing International, or SMIC as it's known, it's China's leading chip maker, but the US technology curbs apply to their supply chain. So we asked the Commerce Department, hey, this 7 nanometer, is it bound by the existing curbs? And they haven't responded. It's fascinating.
Interesting. AMH, if this is a massive win for China, how big a loss is it for this White House?
Well, Jonathan, just look at the timing of all of this. This Huawei new phone came out at the same time as you had Gina Raimondo leaving China. She was there to try to put some more formal engagement in the dialogue between Washington and Beijing that really has deteriorated in the last few years. And now a big question, I think, facing this administration is that are these sanctions, these export controls to try to stem China away from that high advanced U.S. technology, are they effective? Are they adequate? That is something this administration will be asking. But it was a triumphant in China when you have the Global Daily Times putting out a political cartoon where Huawei is seen as a vehicle, car on the road, busting through a blockade, trying to stop cars from coming in and saying that they are basically free from these U.S. sanctions controls and export controls. So this topic is certainly not going to be going anywhere anytime soon. But I would say it's up to the viewers to decide whether or not they thought it was a coincidence that this phone was released as the Commerce Secretary, the agency that is in charge of these sanctions, she was on her way out.
Well, AMH, I'd go one step further. The unveiling was so quiet, and it came at a time when they had someone from the outside preaching to them about why their economy may well be, quote, uninvestable. Isn't that somewhat embarrassing now for the Commerce Secretary to be preaching things like that at a time when they've been able to unveil something like this?
Well, what the Commerce Secretary was talking about is what U.S. companies are saying about China. What we've seen in China, and Reuters reported this weekend about their fund, they're putting another $40 billion into it so that they have their own domestic production of these chips to make sure that they still are remaining competitive with the United States.
Quite a breakthrough in the last week. Ed Ludlow, AMH, thank you to the both of you. About 22 minutes into the session, we look like this. We're down by 0.36% on the S&P. On the Nasdaq, we're down by 0.38. No drama. Let's get you some sector price action. Here's Simone Foxman.
Yeah, just about every sector in the red this morning, with the exception of energy. Industrials, the weakest today, led by losses in part in airlines. Airlines have had a terrible August, down 9.5% last month. Transportation companies as well feeling the pain. But September tends to be the weakest month of the year over the past 30 years, seen an average change of down 0.7% in the month, so not setting us up well. We are looking at communication services trying to eke out some gains there. Where we are seeing some upside is the energy sector. Saudis prolonging voluntary oil production cuts for 3 months. It was anticipated that they would prolong these cuts, but 3 months is quite a long time. Russia joining in, and we're seeing the benefit to the major international energy companies, Exxon, ConocoPhillips, even Chevron, which is dealing with some labor concerns in Australia around potential strikes, up now more than 1% in today's trading. John?
Simone, thank you. If you are just tuning in, that has been the news of the last hour or so, the last 50 minutes, the developments with Saudi Arabia and Russia. That move on Brent crude up by 1.3%, $90 a barrel for the first time since November. On WTI crude, about 87, up by 1.9% this morning. That's the crude action. Coming up, your trading diary. 25 minutes into the session, starting the week a little bit lower, soft and negative, down by, let's call it a third of 1% on the S&P 500. Underperformance on the Russell, the small caps down here by 1.8%. That's equities. Let's take a look at bonds. The bond market right now shaping up as follows. 2-year, 10-year, 30-year yields creeping higher off the back of another rally in crude this morning. We're up by 6 basis points on a 10-year, back to about 424 on a 30-year. Further out along the curve, up by 7 basis points to about 436, which incidentally was the high of the year for the 10-year yield in the last couple of weeks. That's the price action. Let's get to the trading diary. The week ahead looks like this. US factory orders and durable goods coming at the top of the hour. The Fed releasing the beige book on Wednesday, plus Fed speak, Collins, Logan, followed by Williams, Bostic and Harker on Thursday. Another round of jobless claims on Thursday as well. And we round out the week, all coming ahead of the G20 summit kicking off on Saturday. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.